Hello and welcome. Today we're going to decode something that's absolutely essential if you're looking at the Indian market. It's called FEMA, the Foreign Exchange Management Act. You can just think of it as the official rulebook for any and all foreign investment in India.
India's economy is just this massive magnet for investors, for startups, for businesses all over the world. But here's the thing. If you want to play, you've got to know the rules of the game. And in India, that rulebook has a very specific name. And that name is FEMA, the Foreign Exchange Management Act of 1999. It's really the central nervous system for every single transaction that involves foreign currency. It's all about making sure trade and payments happen smoothly. And it's all regulated by India's central bank, the Reserve Bank of India, which you'll hear us call the RBI.
All right, let's get into it. First things first, we've got to understand the basics of this rulebook. And, maybe more importantly, who actually has to follow it. So who needs to pay attention? Well, the short answer is pretty much everyone doing business across India's borders. The list is huge. We're not just talking about the big-time foreign direct investors. We're talking about startups trying to raise their first round from an overseas angel. We're talking about Indian companies buying businesses abroad. And of course, the lifeblood of global trade, exporters and importers. It even covers foreign-owned companies in India and non-resident Indians who are investing back home. Okay, so you've got your capital, you're ready to go. How do you actually get that money into India? Well, FEMA basically gives you two main doors to walk through, and picking the right one is your very first, very critical decision. FEMA really tries to simplify things with these two paths. On one hand, you've got the automatic route. This is the superhighway. For most industries, think software, manufacturing, a ton of services, you can bring in 100% foreign investment without asking anyone first. It's the open door policy. But on the other hand, you have the government approval route. This one's for more strategic sectors, like defense or big retail chains or print media, where the government wants to have a say. For these, you've got to get a green light before any money changes hands. But here's a super important point. No matter which door you walk through, you can't just make up a valuation for your company. The RBI has really strict pricing guidelines. It's to make sure everything's fair and that money isn't being moved around sneakily. So if your company isn't listed on a stock exchange, you have to get a valuation certificate from a certified professional, like a merchant banker or a chartered accountant. It's a non-negotiable step for transparency. All right, so the money is in your bank account. Congratulations! But now a compliance clock starts ticking loudly. Let's look at the timeline because these are deadlines you really can't afford to miss. From the very moment those funds arrive, you have just 60 days, 2 months, to officially issue shares to your investor. It is a tight window. Now, this is where the pressure really kicks in. If for some reason you miss that 60-day deadline, you have only 15 days to send every single penny back, no exceptions. But assuming you hit the mark and the shares are allotted, another clock starts. You now have 30 days to file a specific report, Form FC-GPR, with the RBI. It's a chain of events that has to be perfect, and the reporting doesn't stop there. For instance, if you're just transferring existing shares, say from an Indian founder to a foreign investor, that has its own form, FCTRS. Then there's the annual stuff. Every single company with foreign investment has to file something called the FLA return by July 15th each year. Now, the good news is the RBI has tried to make this easier by creating a unified online portal, so most of this reporting happens through one place called the Single Master Form. But, FEMA is about way more than just selling shares. It also lays down the law for how you can borrow money from other countries, some special rules for startups, and, of course, the rules for international trade. So, let's say your company wants to take out a loan from a foreign lender. That's called an external commercial borrowing, or ECB. As you can see here, the rules are pretty clear. For smaller loans, there's a minimum 3-year payback period. For the really big ones, over $50 million, it's 5 years, and you'll need government approval. But look at the bottom. This is the most important part. You can't use this money for just anything. It's meant to grow your business, not for speculating in real estate or playing the stock market. Now, FEMA gets that startups operate a little differently, so there are special, more flexible rules for them. The most popular tool by far is the convertible note. It's basically a loan that can turn into shares later on. This is perfect for early stage companies where figuring out a valuation is, almost impossible. The rules are pretty simple. A minimum investment of around 28,000 US dollars, and you've got 5 years to convert that note into equity. And, yep, you guessed it, it has its own special reporting form. And what about businesses that are actually selling goods and services overseas? Well, FEMA has a clear checklist for them too. After you get your special code and file all the paperwork, here's the big one. You have to make sure you get paid for your exports within 9 months. This is a huge deal because it ensures that foreign currency earned by Indian companies actually comes back into the Indian economy. Once you get the money, you just show the proof to your bank and you've closed the loop.
So, with all these rules and all these deadlines, it's pretty clear you could make a mistake, but under FEMA, a simple mistake can be incredibly, incredibly costly. So let's talk about the high price of getting it wrong.
So what actually happens? What if you miss a deadline, you file the wrong form, or you just forget? Well, the consequences are no joke. They are designed to make absolutely sure that everyone takes these rules very, very seriously. Okay, get ready for this. The headline penalty is just staggering. You can be fined up to 3 times the amount of money involved in whatever went wrong. So let's say you made a compliance error on a $1 million investment. That could turn into a $3 million penalty. It's designed to be painful. And it doesn't even stop there. For every day that the violation continues, you can get hit with an extra daily fine. But honestly, here's the real killer for any growing company. The RBI can actually block you from raising any more foreign money in the future. That could literally stop your company's growth in its tracks.
I know, after hearing all that, this whole thing can seem pretty overwhelming. But the goal of FEMA isn't to scare you away. It's actually about creating a system that's so clear that you can turn all this complexity into confidence. And it's all built on a very simple idea.
This quote from India Briefing just nails the philosophy behind it all. It says, yeah, the rules are detailed, the paperwork seems heavy, and the deadlines are tight. But, and this is the key, they apply to everyone equally, from the tiniest startup to the biggest multinational corporation. And because of that, they create a transparent, level playing field for everybody.
So what's the big takeaway here? It's this. FEMA isn't some giant wall designed to keep you out. It's a roadmap designed to guide you in. It lays out the exact path for a successful, compliant journey into one of the most exciting markets on the planet. The only real question left is your team ready to read the map? Thanks for tuning in.